Hi there, welcome to the Investment Masterclass, how to effectively use asset allocation to improve your investment returns. My name is Adrian Nathaniel. I'm from Triple Impact Advisory, and I'm delighted to be presenting this to you today. So some of the things we're going to go through is to learn what assets are, what asset allocation actually is, and look at the risk versus returns on each of the assets. And then to learn how to strategically allocate your capital appropriately. And I'm going to talk to you about risk adjusted returns, and then find out how asset allocation changes over time. And then I'm going to explain what a megatrend is and how that can actually impact your investment returns. And then I'm going to explain what the role of speculative investing is in your portfolio. So first of all, what is an asset class? Well, traditionally, there are 6 or 7 main asset classes, from cash, which is like the money in your bank account, fixed interest, which is term deposits or government bonds, green bonds, climate bonds, property, which explains itself, gold, infrastructure, which is around utilities and anything to do with connecting people, and of course shares. And um, as you may see there, there's no asset class which is called currency. Currency is not really considered an asset class as such. It's more of a medium through which we can trade or exchange value. Now, the over the last few years, cryptocurrencies have been evolving, and there's been a lot of interest in this space. It typically it actually is falling into an asset class which is around digital infrastructure, uh, based on the technology that it runs on, the blockchain. Um, so, so this is something that is continuing to evolve as well. There is also another asset class known as alternatives, and that is in relation to commodities. Gold sometimes fits into this, but gold is its own unique asset class as well. And alternatives can also be other real assets as well, such as water, etc. So, let's look at the risk versus return. Now, each of these asset classes actually has a level of return on your money. And depending on what the asset class is, it'll have a higher return or a lower return. And also, that correlates with the amount of risk. Now, as you can see here on this chart, cash is down one end of the spectrum where there's a low return, and particularly at the moment, it's under 1%. Anything in that area is actually returning less than inflation at the moment. Now, and there's also obviously it's a low risk as well. Um, the Australian government has guaranteed the $250,000 in a bank account. Um, so it's because there it is low risk. At the other end of the spectrum, we see shares. Now, shares are basically ownership of companies, and so there's it's publicly listed companies that I'm talking about. So anyone that has a share in a company has the risk of volatility, and that is really volatility is associated with short-term fear, and so it doesn't really reflect the true value of a company. And so if you are targeting a company that has inherent value, and which I believe companies that target sustainability, that actually are considering the planet and people that work for them, the places from which they operate, the communities. There's an inherent value in there, which I'll explain a little bit later on as well. So typically, regardless of the volatility, the it'll always come back to the true value of the company. And so that's why I always say you've got to wait for at least a year before you can have an idea of what the true value is of a company when you've invested in there. And the other asset classes, from bonds all the way through to infrastructure, they all have varying levels of risk in relation to their returns. Okay, and so essentially, when putting together a portfolio, it's all about managing risk. That's the number one thing to look at. And so, and of course, the best way of managing risk, well, the first way to think about of managing risk is to diversify across the different asset classes. And you can see that in nature as well. In fact, with the agriculture, if you see the way that it has been done in the last 50 to 100 years, there's monocropping where you just grow one crop of something, and you'll see that it really attracts a lot of pests and disease around that, and it becomes hard to manage. Whereas the fundamental principles of permaculture, where essentially it's allowing the diversity of nature to flourish, there is less problems with disease and with pests as well. So the same thing rings true for investing. It's fundamentally about diversifying across the different asset classes. Now, one of the other things that I'm going to talk about as well is being able to reduce the correlation between the different asset classes, and that's what a risk-adjusted return is. So if you investing in the share market, like just doing share trading, you're investing in a publicly listed company, or a bunch of publicly listed companies if you're an ETF. Now, the issue there is that they've got high correlation with each other. If there's any sort of fear or short-term volatility, everything in that portfolio is going to be affected by that volatility, because they've got a high correlation with each other. And so what the aim is really of a balanced investment portfolio is to diversify across different asset classes that have a low correlation with each other. And so this is where we start looking for other asset classes, such as property, which has where you can find funds that have a portion of their holdings in that fund are unlisted. That means they are directly owned, just like your a residential property, investment property, or even a commercial property that you may own in your portfolio. If you own it directly, it's not listed on the stock exchange, then it has a low correlation to any financial market volatility, and which helps to balance out your portfolio. So the other area there to look at is also around gold. Now, gold is an interesting asset class because it has an inverse relationship to equities or shares. And so for this reason, it's traditionally been used as a safe haven when financial markets are volatile. And we've seen this like in during the COVID pandemic in 2020 in March, where no one knew what was going on. There was a whole lot of fear around, and people started selling off their shares and moving into gold, and so gold started to increase. And so the thing with this sort of thing to be aware of is that 8 out of every 10 years, the share markets are going up. And so with gold, it's during this time, it's not really doing anything. Over historically, what we've seen is that out of 2 out of every 10 years, we may see a bear market, where a bear market is where the market drops by at least 20%. And it may happen for one, or may go longer for up to 2 years, and that depends on a lot of different factors. But like I said, that only happens maybe 2 years out of every 10 years. Generally, the market's going up. So another asset class that is really worth considering in a balanced portfolio is infrastructure. Now, like I said before, infrastructure is all those assets that connect people, whether it be roads, transportation. It's even in the area of digital infrastructure as well, which is the internet and um, mobile technologies. And this is where I believe the blockchain technology can fit in as well, and particularly when you look at some blockchain cryptocurrencies like Ethereum, that is really about building the infrastructure of the future. So anyway, this is one of the asset classes here, and another way to make sure that it is has a low correlation to financial markets is to have directly owned assets. And an example of that may be like a solar farm, where it's not publicly listed. It's being built, and you buy a portion of that. The thing to consider, excuse me, with unlisted assets is that your investment in them may be illiquid for a period of time. That means you cannot withdraw it. And there's usually a period of time that you cannot access your capital. And it's just like owning a property. By putting your money into a property, you cannot access your money until you sell the property. And so that's what it is meant by illiquid. So that's the same thing to consider with unlisted assets, is that there is a period of time where they are illiquid. So regarding a good balanced asset mix, okay, so this is where we start to look at, well, what percentage of the assets makes up a balanced portfolio. Now, because of the inverse relationship that gold has, typically we only recommend only around about 5% of your portfolio to be in gold. Property can take up to 10 to 20%, and then we've got some of the other assets, uh, asset classes like shares as well. They make up the balance of the portfolio. Now, the other thing to consider is to further diversify within the asset classes as well. So what I mean by that is that even within the area of shares, you can diversify even further by only choosing um, across international or Australia. And typically, if you invest all in one country, you increase the risk of being impacted if there is a recession in that country, and that is known as political risk as well. Geopolitical risk is whenever there's a war happening in a particular country. So for that reason, it's best to diversify across countries as well. And then even further by diversifying across different sectors. Now, a sector might be the health industry or technology or consumer staples. So you want to make sure that whatever you invest in is diversified across those different sectors as well, because you never know, a different sector might be hit hard by a particular government taxing, or there might be huge like a new law being passed, like for instance laws around plastic bags have impacted a lot of consumer staples companies as well. So now the next thing to consider is your actual personal risk profile. Now everyone is different, and everyone has a different tolerance to risk, and when I say risk, the volatility. And it ranges between conservative to growth. Now, conservative would have most of their portfolio in defensive assets. So defensive assets are those assets which have a really low correlation to volatility. and they are things like cash or bonds, and the other end of the spectrum is growth. And so this is where most of the portfolio is in assets that have a higher correlation of volatility, but there's also the higher chance of better returns as well. So megatrends, and how do they impact your investment returns? A megatrend can be defined as a significant event that that impacts your life expectancy, government policy, and your lifestyle, and it's like it becomes a permanent change. And if you think back historically, perhaps the Industrial Revolution can be considered the first main megatrend. And if you think about the products and services that supported the Industrial Revolution, it was oil and steel. And anyone who owned shares of those particular companies did really well at that time. You may be familiar with the names of the Carnegies or the Rockefellers. They own significant amounts of shares in their companies. So that mega trend is well and truly over. In fact, in 2015, the CSIRO commissioned a report into the new mega trends that are unfolding, and it was found that there was around 5 main megatrends unfolding, and three of them that I've got here are around aging populations. The number of centenarians, people over the age of 100, are growing around the world. And so if you think of the products and services that will be supporting that, it's the health and aged care. The other one of the other megatrends obviously is digital tech. Technology companies have been doing really well over the last few years, and it will continue to disrupt the way business has been done. And another big megatrend that is occurring is climate change. And uh, there's no doubt that it is occurring these days. And so how this is disrupting the financial system is in relation to the Paris Agreement, where over 190 leaders from around the world agreed to try and limit temperature rise under 2 degrees. And so to do that, they've agreed to try and reduce carbon emissions. And this has led to a number of innovations in companies, as well as companies trying to decarbonize. And so there's a whole megatrend around this where managed funds, there's been a huge influx into sustainable investing, and it's been actually getting great returns as well. So another asset class that I'd like to touch on is speculative investing. Now, speculative investing is typically around a startup ecosystem. And these are for companies that are just starting out. They may have a new innovative idea, and they're not really tested or tried yet, but they're just going through a capital raise to get going. Um, traditionally in this area, it has been really illiquid. So whatever money you put into a startup company, you may never see it again. However, there is an opportunity, there is potential there to get like 100, 200, 500% returns if they do really well. Now, in the space of what we've seen in the last 5 years with cryptocurrencies and the ICOs, and now the security token offerings, is that this startup space is becoming more liquid, and this is really changing. It's a big game changer for the startup ecosystem, and allowing, I guess, to reduce the risk a little bit with speculative investing. Nevertheless, the general rule of thumb with speculative investing is to only put in whatever you can afford to lose. So Let me just go through some of the foundational principles that I like to consider before putting together an investment portfolio for my clients. And the number one thing is to manage risk. And this is what I've been going through in this session here. It's essentially understanding asset allocation and diversifying appropriately across the different asset classes. The next thing I like to consider is sustainability. And the main reason is that if you think about it, a company that is targeting sustainability, if they're looking at reducing their carbon footprint, they're going to save money on their energy costs. If they're looking after their staff, they're going to increase their productivity. Furthermore, what I've been seeing also is that companies that target sustainability, they're more proactive about this. They get less environmental fines and less corporate violations. So there's it when companies are targeting sustainability, it inherently manages risk as well. And some of the other things I like to consider is you need to make sure that whatever investment option you're choosing is affordable and that they are actually performing well. So I'm going to leave you with some words to ponder. Ultimately, investing is about time in the market rather than trying to time the market. It's really hard to get in at the bottom, and so there's different ways of being able to manage that as well, which I'll go through in another investing masterclass. And finally, this is a question I often ask myself before considering investing: is what value is this going to bring me, my community, and the planet? Because ultimately, if for me, I believe if you're just chasing money, it's like planting a foundation in sand. It won't last long. So by considering the impact for your community and the planet, it gives it a much more solid foundation. So if you've got any questions about anything that I've said, feel free to get in touch. My phone number is 0439 663 562. My email is adrian@tripleimpact.com.au. I look forward to hearing from you. I hope you found some great value in this masterclass. Thank you. Bye.